Money Leaves Canada by www.options-trading-education.com. Time-honored advice for when you want to understand something is to follow the money. Now, as money leaves Canada at the fastest pace among developed economies, we look at what happened. Bloomberg Business writes about money flooding out of Canada. Money is flooding out of Canada at the fastest pace in the developed world as the nation's decade-long oil boom comes to an end and little else looks ready to take the industry's place as an economic driver. Canada's basic balance, a measure of national accounts that spans everything from trade to financial market flows, swung from a surplus of 4.2% of gross domestic product to a deficit of 7.9% in the 12 months ending in June, according to analysis from Kamal Sharma, a foreign exchange strategist at Bank of America Merrill Lynch. That's the fastest one-year deterioration among 10 major developed nations. More recent data on where companies and mutual fund investors are putting their money show the trend extended into the second half of the year, suggesting demand for the Canadian dollar and the country's assets is still ebbing. The currency is already down 11% this year after touching an 11-year low against the US dollar in September. Foreign investors are taking their money out of Canadian dollars, and Canadian investments and Canadian investors are looking abroad for opportunities. What opportunities does this present for the options trader? Forex options on the Canadian dollar. As investors convert Canadian dollar to US dollars, Great Britain pounds, yen, Swiss franc, Australian dollar, or euro, the Canadian dollar will fall in value in relation to these other currencies. If you believe that the money leaving Canada will continue, it may well be time to buy puts on the Canadian dollar versus the US dollar, yen, or euro. At the current time, one Canadian dollar is worth 76 cents. The Globe and Mail says that the Canadian dollar is likely to fall to US dollar 72 cents and remain low through 2017. If you're counting on a rebound for the Canadian dollar anytime soon, don't. The latest forecast from Bank of Nova Scotia suggests the loonie is poised to tumble to as low as 72 cents US. Not only that, when it recovers, it won't crack the 80-cent mark even by the end of next year. Interest rate differentials will move against the Canadian dollar as US interest rates rise. Sean Osborne, Scotiabank's chief foreign exchange strategist, said in the report, referring to the fact that the Federal Reserve is moving ever closer to a rate hike, while the Bank of Canada is expected to do nothing on that front for some time yet. Low energy prices. We see no rebound in crude oil until later in 2016 amid a continued supply glut, and sluggish domestic growth imply continued downside pressure in the Canadian dollar through 2016. The Canadian dollar is caught in a double whammy of low oil prices and a US dollar that is likely to rise as the Fed raises interest rates. Rather than trading options on oil, one could trade options on the loonie as money leaves Canada by the truckload. If you are interested in Forex options trading, read our article on the subject. For more insights and useful information about trading options, visit www.options-trading-education.com.